Okay, very interesting discussion in my 2 minutes. I'll just first throw out a basic point. I really appreciated what the previous two speakers had to say. I think that those comments were completely independent of any current historical context, which is that the financial system had a massive historic meltdown. And we would all be living through a Great Depression if not for the financial system having been bailed out and if not for the massive deficit spending that the government made to prevent a depression. So the discussions about the efficiency of the market have to be placed in that context. Okay, so number one, more trading is beneficial. Trading is always beneficial, and the small investors are doing the efficient trading and bring us to rational values. I just want to first quote a couple statistics. Over the decade 1970 to 79, now I'm going to give you a ratio. The ratio of stock trading, the amount of stock trading relative to productive corporate investment, it was 1.3 times, so 30% more trading than there was productive corporate investment. Over the decade, now this is before the crash, over the decade 1998 to 2007, the ratio was 26.8 times. So we've gone from 30% more to 2,060% more. Okay? Now, the notion that over the decade of the 1970s, we were so inefficient and that we have increased the level of market efficiency so dramatically through the levels of trading that we're talking about seems really implausible to me, since the rate of growth of corporate investment was higher. Okay, secondly, that the speculators drive prices to their rational values. This is a common argument. It was made by Milton Friedman probably 50 years ago. It again completely ignores what's just happened. What really happens is the high levels of speculative trading feed into a herd mentality, and that's how you create bubbles. And the bubbles are what is responsible for the crash. Moreover, what feeds the bubbles is the traders who are getting fees through trading. So whether or not the trade is valuable to the people that are owning the stock, the traders are getting their fees. So they encourage the bubble. The credit agencies, Standard & Poor and so forth, encourage the bubble because they're all getting fees. And then the market crashes because of the excess of speculation, and these people get bailed out. That's really what's happening. It is not, the excessive trading is not creating market efficiency. We know that for a fact. Will a speculation tax solve all these problems? Absolutely not. It is one measure among many. And we've talked about this one. It's the focus. It has the advantage of doing two things, and we can modulate. The tax. If we want to use it to raise more revenue, we lower the tax. If we want it to reduce speculation, we raise the tax.
Okay, thanks. You made a lot of the points I would have wanted to. A couple things just I'll emphasize. Your calculations that would involve, in effect, doubling the transactions cost. That was pretty much what Bob and I had calculated. We figured we constructed tax rates that were quite consciously designed to roughly double transactions costs. And, of course, we also assumed a 50% reduction in trading volume. Where I come from, if you double cost, reduce volume by 50%, you're paying just as much as before. What's to pass on? Less business for Wall Street. I'll shed tears some other time. The other point that was very, very useful, you pointed out that there had been a sharp reduction in trading cost over the last 10 or 15 years. Exactly right. We're going to bring trading costs back to where they were 10 or 15 years ago. You know, I was alive in the 80s, even the 70s. We had a pretty vibrant capital market back then. You know, we did pretty well in a lot of ways. So, yes, that's right. We'll bring trading costs back to where they were 10 or 15 years ago. We'll crowd out some arbitrage traders. Yes. Exactly what does that mean? You know, let's imagine that there's this true price of oil out there. It should be 75 a barrel, and we have, smart traders who could look and see that, oil's out of line at, 74.90, and they would jump in. But because of our tax, they're going to wait till it's 74.86. Should we be worried about that? I'm not, but maybe we should be. Yes. Arbitrage traders, there'll be bigger margins versus what we might envision, the true price should be, insofar as that could be determined. Or, I'm being a little crude here. There are actual spreads you could point to that would be somewhat larger in this case. The other part of that story, though, there'll be less money in arbitrage trading. Well, that's short-term trading. What does that mean? Well, if there's less money in short-term trading, well, what do people do when there's less money? They leave that industry. They go look for long-term gains. That doesn't bother me. So long and short, what we have is a situation where just about every effect of this tax to me looks good. One last point I'll just make. You know, you read the papers today, we got these deficit commissions. These guys are intent on cutting Social Security, Medicare. There's proposals for a value-added tax. They want to tax our food, our medicine. You know, it's your choice. You think that's better? That's what's on the table.
I'm glad, I think we can agree on some things. You said it basically absolutely not, that would fix any of the problems. No, absolutely not is what you said.
On its own.
Okay.
I think it's every problem.
Now, the other thing you said is, well, bubbles lead to crashes. Yes, but I teach a course in financial crises, past, present, and future at Georgetown. And if you study the history of financial markets, even in days when very high transaction costs, you still had irrational bubbles and panics and crashes. It's a normal part of human behavior, and making it more expensive to trade is not going to stop the real speculators. What it's going to do is it's going to wipe out the traders who basically make it easier for regular retail investors to trade at proper prices. So yeah, you're going to raise money, but where you're going to raise it from is not from the Wall Street types. The incidence of this tax, I should say the incidence of the DeFazio-Harkin tax, and I think it's very important to refer to this as the DeFazio-Harkin tax, because this is very different from the transaction tax in the UK. The UK has a transaction tax, and by the way, it's a complicated tax. There's a 320-page manual for that tax. It's not easy. But it exempts all registered intermediaries, i.e. Wall Street. And so UK, they basically stick it straight to the end investor, and they don't even attempt to tax the intermediate trades because they understand those are necessary for making a financial center work. So basically, we're not going to eliminate bubbles. We're not going to eliminate crashes. We are basically just going to have a very inefficient tax. And if we're going to have a tax, let's step back and say, okay, what is the best way to have a tax? And personally, I think for purposes of national security, energy security, economic security, a carbon tax is the most efficient and fairest thing to do. But that's just my own personal opinion.
Well, I would like to put this in context. Actually, the crisis that we went through over the last couple of years had nothing to do with the stock market. Absolutely nothing to do with the stock market. There was not a bubble in the stock market. It had to do with subprime loans that put pressure on the financial system that was driving the banks under. So there was no bubble in the stock market. There was not excessive speculation in the stock market that created this whole situation. I would point out that, yes, there certainly is much more trading in the stock market than there was previously. Why has that happened? There are two very significant changes in the marketplace over the last decade. One was called change in the order handling rules back in the 1990s. Another was Reg NMS. Two somewhat arcane topics. Just suffice to say, it led to the creation of many more trading venues than we ever had before. A decade ago, there were three places where you'd buy a stock: the NASDAQ, the New York Stock Exchange, or the American Stock Exchange. Today, there are more than 40 different venues where you buy a stock. You can imagine that on one venue, a stock gets priced at a certain level, another venue is priced at another level. There are mispricings. It's very hard to imagine that all stocks are going to be priced at the same prices across these multiple venues. And so arbitrageurs are seeing, well, wait a minute, it's trading at this level over here and at this level over here. I can buy it here, sell it over here, and make money and bring those two markets together, as Jim was talking about earlier with the ETF example. So you've seen this tremendous increase in trading because of the massive increase in the number of venues. I would also point out that it is this massive increase in the number of venues that has lowered the overall transaction costs. So we are pleased to see transaction costs come down. I do not think think that if transaction costs were to double, that all of a sudden you would see the number of transactions cut in half by true long-term investors. The market efficiency is still going to be what it was, although impaired. And so you're still going to have turnover, if not 100%, close to that level. In fact, we had 100% turnover a decade ago in the average active equity mutual fund. So the transaction costs will go higher for individual investors in their mutual funds. The worst thing of this is that it's totally opaque. We live in an era where we want things to be transparent. We value transparency. All of this would be opaque. It would not be calculable in a prospectus or in an annual statement. It would just show up in lower performance that the investor would realize. The transaction fee itself, the transaction tax itself, would not be stated, or if it would, it's going to be a footnote, and the transaction costs are certainly not going to be stated.